So great, Martine, if we can start here, I will begin reviewing the global outlook, and then we will be sort of narrowing down more specifically into regional dynamics. In particular, we'll start looking at the Russia-Ukraine war and the outlook there, and some risks emanating from there, and the latest updated risks that have been with us for the last year and a half now. And then after that, I will hand it over to Martine, who will walk us more through the Western Europe outlook with the focus on the Big Five in particular. So first things first, related to the global outlook, as you can see from our slide here, a bit of a slowdown in the bottom left part of the chart here, a bit of a slowdown in GDP growth this year compared to last year. However, this is actually an improvement in our forecasts. Consensus forecasts are also higher than where they were initially, say 6 months ago or 9 months ago, and we have likewise raised our forecasts as well. And then for next year, a further bounce back again. So recovering some of the lost growth this year more into next year. A lot of this is related to, on the one hand, the US economy being far more resilient than initially expected and continued resilience. We're expecting now through more or less the end of the year, with more of a slowdown then pushed into the last months of this year and into the beginning of next year. And likewise, of course, with China's ending of the zero COVID policy in December of last year, obviously a bit of an uptick in growth in the first half of this year. Though that said, we are not seeing quite the robust revival that many may be expected out of China in the first 6 months of this year. So more of that demand coming in the second half of the year. In particular, with those demand factors, right, taken into account, on top of the supply issues, we can look at the major areas where we've seen considerable cost increases that have been impacting multinationals' businesses for the last couple of years here, and then the outlook going ahead. In particular, what we would say is that looking into next year, looking towards the end of this year and into next year, you're going to continue to struggle with quite high food prices, also matched with quite high labor costs. So obviously keeping up some of those core costs for your business. That said, we do expect that currencies will be working in your favor, as we should see more strength of currencies around the world against the dollar, and then energy prices also subsiding a bit next year. Nothing terribly dramatic, but still coming down next year compared to this year. So that'll be beneficial, while likewise shipping and logistics costs coming down a bit as well. Looking at oil prices more specifically, we have revised down, in fact, our forecast for oil prices for this year and for next year. So again, as mentioned, just minimally down next year, but again, movement in the right direction. And for this year, we are still seeing very low oil prices in the first half of this year, despite the continued cuts by OPEC, the additional cuts by OPEC, as well as Russia's cuts as well. Russia has promised to cut by 500,000 barrels per day through the end of the year. Despite those cuts, markets have interpreted that, in fact, as proof of the weak demand within the global economy. And so instead of driving prices up, it's actually pushed prices down to a degree. We are still expecting demand to pick up at the second half of the year, hence energy prices going up in the second half of the year. For your Western Europe portfolio, of course, this will naturally keep up some of that inflationary pressure, at least through the end of the year, and then moderating more substantially next year. Looking at then food prices, so we can say conclusively that we believe that the worst is over under current conditions, right? So major caveat there, which I'll explain in a second. But you can see here, looking at the food price index overall, yes, food prices are still at an elevated level, right, compared to the historical track record. We've had, obviously, food prices ascending pretty consistently every single month for about the last 2+ years now. That said, they are moderating to a degree, but they will not moderate back to be consistently at that 2014-15 level for some time. A major caveat that I mentioned would be the grain export deal between Ukraine, Russia, sort of forged by UN and Turkey. Russia, just in the past week, has made very negative comments about extending the deal, saying that the deal has no future. So watch out for that here in the next month. The deal expires in the middle of July. If we see Russia leaving that deal and then stopping Ukrainian grain from being exported, you would see another considerable spike in food prices that would actually have a pretty tangible effect on your portfolio. Looking at producer prices, obviously all of the costs that I've discussed so far, Contributing into that, again, the worst is generally over. Shipping and logistics costs having moderated considerably, food prices down a bit, energy prices down a bit across the board. All of this, of course, is helping sort of moderate, slow some of these consumer prices, and specifically within the Eurozone, who felt sort of the worst of it. When you look at all of the producer price pressure, globally speaking, we are seeing considerable improvements there, which of course is naturally helping business sentiment. So with all that said, sort of the global picture, moving then into very briefly our latest evaluation on the war in Ukraine and our updated scenarios. So as you can see here, in terms of our scenarios, as far as likelihoods, we have moderately altered them. So in the past, our base case expectation was scenario 3, which we put at 50% likelihood, moving towards a frozen conflict. We have now lowered that minimally, and we have raised, we have compensated for that by raising scenario 2 minimally. So now we see it as almost equal likelihood that we could either have more or less a frozen conflict after this ongoing offensive, counteroffensive led by Ukraine, or we would see of almost equal likelihood Ukraine potentially more or less winning the war, which would be a scenario that would manifest itself, though, deep into 2024. So there'd have to be not only large successes in this current counteroffensive, but then even potentially a small counteroffensive perhaps before this coming winter, and then another spring offensive, and likely another offensive after that in the summer of next year. So multiple successful counteroffensives over the course of the next year and a half that would then lead Ukraine to victory. We have altered this view in light of the fact that, for one, we have seen a clear shift in Western rhetorical and military and financial support towards Ukraine over the last 6 months, but more specifically in the last year, with now Western governments speaking more in support of Ukraine actually winning the war, and not simply, as the policy had been since the invasion, avoiding a loss for Ukraine while also avoiding a loss for Russia, so as to avoid Russia being pushed into a corner and perhaps escalating across the nuclear threshold. We are now seeing Western governments more aggressive and considering the amount of financial support as well as the military support, the hardware, the artillery, the tanks, promises of jets coming, now much more seriously supporting Ukraine to potentially win this war. So that's fundamentally why we've raised scenario 2 to become slightly more likely. Watch for the next about 2 months, as is expected. Military analysts expect that this counteroffensive will proceed for the next couple of months. It all depends upon these next 2 months, basically, to see how it goes. Martin, you can bring up all the animations here. What to watch out for as it pertains, aside from just sort of the war dynamics, what does this mean for Western European markets? First things first would be the sanctions on oil and how Russia has responded. So far, we've actually seen, obviously, clear escalation in this area with not only sanctions, the embargo on oil going to Western markets, but then also a price cap on oil if that oil is routed using Western logistics to get to other markets even. So with that being the case, we have seen Russia actually retaliate and cut oil output. This may be calling virtue out of necessity. Russia likely was probably forced, in fact, due to inability to continue such high levels of output, to make some of these cuts, which are planned through the end of the year. But in either case, we have seen some retaliation. The point being, we actually have not seen, however, a severe uptick in oil prices. We've actually seen the opposite. We've seen oil prices coming down a bit over the course of this year, which means that has actually protected Western European markets. The concern here naturally would be if we would see Russia cut even further going forward, perhaps in response to, say, the counteroffensive. That could be problematic naturally for oil prices. The second point here, possible confiscation of Russia's $300 billion in reserves. This has been an ongoing discussion across the Western world for about the last year, and each month there's sort of consistent development towards trying to do this. The West has effectively agreed at a moral level, at a political level, based on economic need as well, that they do intend to proceed to do this, to confiscate Russia's FX reserves. The legal avenue basically being the outlier here and the difficult one to manage at the moment. That said, we are seeing a lot of activity across the Western world to try to find this legal avenue to confiscate Russia's FX reserves, including just in the past week, the US Congress supporting a bill which looks set to pass to confiscate Russia's sovereign assets within American territory. So obviously, if that proceeds, that could give perhaps a signal to Western European governments to do the same. The point here is that how would Russia retaliate to this? This would be, of course, highly escalatory in the war, and you could see likewise a confiscation, perhaps unfortunately, of Western businesses' assets within Russia, obviously in retaliation for the confiscation of Russian sovereign assets within the Western world. So something to be paying attention to, but the point here is that Ukraine's reconstruction cannot be serious and cannot take off with any considerable strength without this foundation of Russia's over $300 billion in FX reserves. There simply won't be enough money to help fund the needs for the reconstruction, which are likely to amount to about $1 trillion in the end, by at least one rough estimate. And then, of course, another source of escalation would be how this offensive, the ongoing Ukrainian offensive, continues. If there are strong successes here in the coming weeks, how would Putin potentially retaliate? Crossing the nuclear threshold, perhaps cutting oil and gas exports, etc.
Hi, my name is Krista Reganey, and I'm the Marketing Director here at FrontierView. I'd like to thank you for watching a segment of this webinar. If you'd like access to the full video and our latest insights, data, and research, sign up for a free trial with us today. Simply scan the QR code on the screen.